Hi, everybody, and thanks for joining the Zoom meeting. I am Kurt Domber of FSG, point of sale for insurance strategies and products. I will try to keep this to about 15 minutes with added time at the end for questions. But first, let me thank you for your continued support of me and my firm. Even in this strange time, we are doing business and we are slightly ahead of last year's production levels. So again, thank you very much. For those of you that don't know FSG, we are here for you, the financial advisor, to help in estate planning, life insurance, and long-term care sales and marketing. We are your point of sale. I've recently been on multiple calls related to the election, and without getting too political, let me summarize what I've been hearing and highlight some issues that your higher net worth clients might be asking you about, and some opportunities that I'd like to make you aware of. First, the election. There's about a 55 to 60% chance that Joe Biden will win the election. But remember what they said about Hillary, so it's all an educated guess. Most importantly for us, there is about a 53% chance that the Dems will take control of all three branches of government. For Trump to remain in office, he either has to win at least Florida, and if not, he has to win all of the other 5 toss-up states. Based on polls today, if Biden wins Florida, he wins. Second, the GOP needs 19 seats in the House to take control. Consensus is that this will not happen. The Dems need 3 seats in the Senate to take control. Consensus is that if the Dems take at least 2 of 3 seats of these 3 states, North Carolina, Maine, and Montana, they will take control of the Senate. Third, on the election, governorships. Why are they important? The census is completed in 2022. Congressional districts are redrawn by the governors and the legislature. Once redrawn, gerrymandering could help control Congress for the next 10 years. If the Dems take control of all 3 branches of government, there will be tax reform in 2021. If the GOP keeps control of the Senate, major tax reform will be blocked. So, what happens if the Dems do take control of all 3 branches of government? Well, we expect corporate taxes to go from 21 to 28%. Remember, it used to be 35%, so the consensus is no real huge impact. The top personal income tax bracket will go from 37 to 39.6%. Again, we expect this to have no great impact. But the highest income earners, those earning $700,000 to $1 million plus, could see their long-term capital gains and dividends taxed as ordinary income. This will be a big deal. For high income earners, the combination of these could be a problem, but it could be an opportunity for us to come in and help. What might be an opportunity is for the high income earners to look at alternative investments. Consider investments that have market exposure and opportunity without taxes on gains. Consider accumulation universal life, which has minimum death benefit, max accumulation tied to indices, where distributions are taken as 0 net cost loans, not taxable income. An example is a LERP strategy or a supplemental retirement strategy. Let me give you an example. So this client, as an example, major goals of supplementing his income, managing and lowering his taxation. He's a 45-year-old male, preferred non-smoker, a Henry. High income earner, not rich yet, Henry. He contributes $50,000 a year in annual premium for a total of 15 years, or a total of $750,000 for the life of the program. The premiums on the universal life policy, the accumulation index universal life policy, are flexible. So if he skips a premium, it's fine, as long as he's got enough to cover the cost of insurance. If he skips a premium or reduces a premium, he can make it up later. He can extend the premium payments. the premiums are flexible. But for our example, let's use $50,000 a year in annual premiums for 15 years. Let's assume a 5.67% annualized gross rate of return on the index. Let's look at a summary of the policy. So the policy starts off for this 45-year-old male putting $50,000 with a minimum death benefit of about $1.2 million. Not a lot of death benefit, but again, remember, the objective here is max accumulation. We earn an average of 5.67% for the entire length of the contract. The $50,000 is paid for 15 years for a total of $750,000 in outlay. At age 65 to 79, he's going to take the maximum allowable distribution, or $129,826 per year in supplemental income, for a total over that 15 years of almost $2 million. So, for $50,000 a year paid for 15 years with this 5.67% rate of return, he's going to be able to start taking $129,000 over a 15-year period for a total of $2 million. As in, $750,000 put in, $2 million taken out, no taxes. How do we get to no taxes? Well, these distributions of $129,000 per year are taken out as loans. And the loan is what they call a wash loan, or a net zero rate of return, or a net zero cost loan, excuse me. How that works is what the insurance company does whenever this client borrows money out of the contract is segregates the cash value in the contract into a fixed holding tank. In essence, that secures the loan. And then they loan the monies from their general fund. In years 11 and beyond, so again, you don't want to take distributions out of this in the first 10 years, but in year 11 and beyond, the interest rate earned on the fixed account that was segregated to secure the loan is exactly equal to the interest rate charged on the loan for a net zero wash loan. In the first 10 years, the net loan charge is like 1.4%. So still not terrible, but there is a loan charge. After year 10, zero wash loan. Okay, let me go back. So that's income taxes. How about healthcare reform? Well, if the Dems take control of all three branches, we do expect healthcare reform. We do expect possibly that the Medicare age will go down to 60. The Affordable Care Act will have a Medicare-like option in it. Biden is not talking about Medicare for all, and we don't expect Medicare for all to actually happen. Long-term care, the cost, the federal government covering costs is not addressed. 72% of your females and 35% of your male clients will need long-term care for 6 months or more prior to passing away. You need to be asking your clients, what have you done about long-term care? And if the answer is I have an insurance policy, great, let's take a look at it. We'll do a policy review. If they say I haven't done anything, but I know it's a worry, let us help. Give us an opportunity to come in and help your clients. An opportunity might also be, as far as funding long-term care, looking at the CARES Act and combining that with a long-term care rider or a long-term care insurance. The CARES Act ended the idea of the stretch IRA, stretching the IRA into the lives of the next generation. It limits the stretch to 10 years. So what we might want to do is look at taking accelerated distributions from the IRA, as long as the client isn't going to need it in their life, taking accelerated distributions in the IRA and providing for long-term care. Let me give you another example. So this client, Mrs. Client, age 68, let me go to the bottom, she's healthy, where we project on the earnings on her IRA to be about 6%. Mrs. Client has $785,000 in IRA assets, total IRA assets, and we are going to suggest taking a withdrawal of just 4%. That 4% equates to $31,400 a year for taxable income, The taxes on that, let's assume she's in the 28% tax bracket. The taxes on that are about $8,800, leaving her a net of $22,608. That $22,608, we use that to purchase an annual premium life insurance policy for a total of $774,060 in total death benefit. That annual premium has to be paid every year. So we're going to pull out that $31,400 every year from this IRA. Remember, we're earning 6% and we're only pulling out 4%. So it should, statistically, it should last. I can change those numbers if you'd like to see how long those distributions will last, if your client's not comfortable with a 6% rate of return or a 4% distribution rate. Whatever you'd like, I can adjust this to meet your clients. But let me continue. The $22,608 buys $774,000 in death benefit. That comes with a 2% long-term care rider associated with the policy, or a total, if the client needs the long-term care funding, of $15,481 maximum per month for 50 months. 2% of 15,481 divided by 774 is 50 months. So it'll last for 50 months, 50 months, a little over 4 years. If the client does earn 6% and they distribute 4%, this is kind of the client's just-in-case money, the comfort level. We are not dwindling the IRA down to zero, and we don't want to show that. We don't want to do that for most of the clients that we're dealing with, because they do see the IRA as kind of their security blanket. This is the IRA Max strategy. The IRA Max strategy is simply accelerate the distributions from the IRA, use those distributions on an after-tax basis to buy life insurance with a long-term care rider, protecting the client in her life and giving the heirs, in this case, almost a double of the value of the asset if the client doesn't need it for long-term care. So with the 4% distribution, we double the value of the IRA and protect the client if she needs it for long-term care. Okay? That's the IRA Max strategy. Let me stop that, and let's talk about estate taxes. So estate taxes. If the Democrats have total control of all 3 branches, we do expect the estate tax credits of $11.58 million currently to be dropped. In some cases, they're talking about a drop all the way down to the $3.5 million level per person. There is portability, and they're not talking about removing portability, but dropping the estate tax credit all the way to 3.5. That's not the consensus. The consensus is you'll probably see a drop of the estate tax credits down to about where the Obama administration was, $5 million, indexed for inflation. So if that's the case in 2021, and they passed the law in 2021, you're looking at an estate tax credit of about $6 million indexed for inflation per person. Okay. If the Dems, let's see, most importantly, if the Dems have control of all 3 branches, what they could also do is remove the stepped-up basis at death, subjecting all of the client's assets to taxation, whether or not the estate is valued at $6 million or more. So if they could, by removing the stepped-up basis, they're going to subject almost all of your business owners, real estate investors, stock investors to some type of tax at their passing, no matter what the valuation is. Let me give you an example of maybe a strategy that we can employ in order to help pre-fund those estate taxes. This is simply looking at life insurance as if it was an investment for the benefit of the heirs. So again, we can pull monies from the IRA, we can pull it from an annuity, we can pull it from discretionary income, whatever it might be. But what we're looking at doing is making gifts to the next generation to pre-fund these taxes, whether it's estate taxes or whether it's income taxes, capital gains taxes at the distribution between generations. So in this case, as an example, we have a 70-year-old male and a 65-year-old female. The 70-year-old male, decent health, okay health. The 65-year-old female, good health. We use a survivorship life insurance policy, and we put this aside as an investment for the next generation. Survivorship insurance pays off at the second death. The distributions will be made at the second death, which is when estate taxes or whatever taxes might be due on a generational transfer. So for these two clients, the cost of a $1 million life insurance is $15,872 per year. That $15,872 is paid forever. Why is this a good investment for the benefit of the heirs? I'm going to take you down to life expectancy. So for these clients, their joint life expectancy, as in when statistically they should have both passed, is about 26 years. The female is now 91 years old. She was healthy going in. She's expected to make it to about age 91. That $15,872 is paid for all years. Why is this an investment? $15,872 paid for 26 years, getting $1 million in tax-free death benefit when both of them pass, works out to be a 6.03% rate of return for the benefit of the heirs. Put another way, if I was to come to your client and say, give me $15,872, and I'm going to give your heirs a 6.03% tax-free rate of return, guaranteed for the rest of, for as long as you shall live, but statistically at 26 years. So give me $15,872 for 26 years. I'm going to give your heirs a tax-free $1 million, and that works out to be a 6.03% rate of return. Do you think they would do it? I think they probably would jump at it. So that is some strategies that might need to be employed if the Democrats take over all three branches of government. In our next webinar, we're going to talk about gifting strategies, aggressive gifting strategies using this low interest rate environment as an opportunity. If your clients decide to do something, or they're in the market to do something, they might want to do it before the turn of the year, because if the laws change, in many cases, the laws change as of the beginning of the year that the law was enacted. So again, if your clients are looking to set up trusts, redo their wills, look at insurance policies to be put inside of those trusts, they might want to do it before the end of the year. Thank you for your time, and it's great having you on board, and look forward to talking to you soon.